Kharchalogy. Today we are going to start with basic accounting terms, but before that I'd like to request you all to please like and subscribe my channel, and don't forget to leave any comments if you have any feedback or suggestions. Let's get going then. Let's start with a very short story. Once upon a time there was a guy named Rahul. He wanted to open a store named Dharma Traders. He started his own business with cash rupees 5 lakh. He then purchased a building for rupees 1 lakh and machinery for rupees 20,000. Rahul then found a supplier named Anjali. He purchased goods of rupees 50,000 from her. Then came Aman. He wished to buy goods from Rahul. So Rahul sold goods to Aman for rupees 12,000. The cost of the goods he sold was rupees 10,000. Wasn't that a very short story? Though there is no moral of the story, but still we are going to learn here the basic accounting terms. First is accounting entity concept. According to this concept, the business and the businessman are two different entities. So here, Rahul and Dharma Traders are two different entities. All the transactions shall be recorded from the point of view of Dharma Traders and not from the point of view of Rahul. Capital. What is a capital? Any amount invested by the owner into the firm is known as capital. It can be in the form of cash or asset. In this case, Rahul invested rupees 5 lakh in form of cash, so the capital of Dharma Traders is rupees 5 lakh. It is an obligation on the business and it is a claim of the asset by the owner. Capital. What is a capital? Capital is the amount invested into the firm by the owner. It can be in the form of cash or assets. Here, Rahul invested rupees 5 lakh in form of cash. So the capital of Rahul into Dharma Traders will be of rupees 5 lakh. It is an obligation onto the business and it is Rahul's claim on the assets of Dharma Traders. So, in case Rahul withdraws any amount of cash or withdraws any asset from the business, it will be known as drawings. Any amount withdrawn from the capital by the owner, it is called drawings. Assets. The economic resources of the business or anything that the business owns that will get benefits in the future. There are three types of assets: non-current assets, current assets, and fictitious assets. Non-current assets are either tangible assets or intangible assets. Tangible assets as in land, building, plant, machinery, etc. Intangible assets means patents, know-how, copyrights, etc. Intangible assets are something that we cannot see. It is intangible in nature. Non-current assets are assets which can be converted into cash within a short period of time, that is, within a year. Current assets can be stock, debtors, etc. Fictitious assets are something that we cannot convert into the cash, that is, preliminary expenses, advertisement expenses that has not been written off, or debit balance of profit and loss account. In this case, Rahul bought building for rupees 1 lakh and machinery for rupees 20,000. Since this will reap benefits in the future for Rahul, these are assets. Since this will also be for a long period of time, this will classify as non-current assets. Liabilities. Anything that the business owes to an outsider, that is called a liability. Liability are of two types: non-current liabilities or current liabilities. Non-current liabilities are like long-term loans or long-term debentures. Current liabilities are something that the business owes for a short period of time, that is, creditors, outstanding expenses, short-term borrowing, etc. Capital is an internal liability, as it is an obligation on the business towards the owner, and external liabilities are the non-current liabilities and current liabilities. Goods. It is the commodity or article that the business is dealing in. Then, what is stock? Stock and goods are one and the same thing. We use the term stock when we are talking about the goods that are available in the business for the purpose of sale or the goods that are lying unsold. When we talk about opening stock, it is the unsold goods that is available in the beginning of the year, and closing stock are the unsold goods that are available at the end of the year. Revenue. It is the income generated by the business or any revenue realized or receivable by the business from the sale of goods or rendering of services. Other form of revenue can be rent received, commission, interest, etc. Expenses. Expenses are costs incurred by the business in order to generate revenue in the form of sale of goods or rendering of services. That is called an expense. It can either be sales, wages, rent, interest, etc. Expenditure. Spending money or incurring a liability to get some benefit in return or property or service, it is called an expenditure. If the benefit of the expenditure exhausts within a year, it is called an expense or a revenue expenditure. However, if the benefit of the expenditure lasts more than a year, it will be treated as an asset or a capital expenditure. Discount. Who doesn't love discount? Discount is a deduction of price sold. It is offered in two ways: trade discount and cash discount. Trade discount is the agreed percentage of deduction of the listed price at the time of selling goods. Cash discount. Debtors are sometimes offered cash discounts in the amount due to incentivize the prompt payment within the stipulated period or earlier. In this case, let's assume Anjali offered a 2% trade discount to Rahul. So, Rahul received a discount for ₹1,000 and his purchase amount became 49,000. Also, let's assume that Rahul offered a 3% cash discount to Aman. He sold ₹12,000 goods on credit basis. So, if he agrees to pay him within 30 days, Aman will receive ₹360 as cash discount. That's all, guys. Thank you for watching. I hope you have understood the basic accounting terms. You will be using this on an everyday basis now. Thank you, and don't forget to like and subscribe. Bye.